Hello and welcome to Portfolio Matters. In this week's My Worst Trade, I will be talking through my own personal investment failings in a company called Hunting PLC. And I'd like to emphasize that Hunting PLC is actually a very good, high quality British drilling company, oil services company. And the failings of this trade were absolutely nothing to do with the company. They were to do with my investment approach. And I hope this will be very informative. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Okay, this My Worst Trade is prompted by our discussion of our investment strategies, which we will be posting today and which I hope everyone will take a look at. So if you have seen that podcast, you will know that I like to follow the oil cycle and the commodity cycle. And this My Worst Trade discusses my failure to get the exit strategy correct. So the key learnings will be: think about your exit strategy. That could be a price, you think it's reached fair value and it's time to get out, or it could be a specific news event. But time is not a very good exit strategy. So saying I'm going to get out on X date, why? Well, that doesn't work. And frankly, that was my exit strategy. It wasn't a success. The other thing I'd like to emphasize, and what this really taught me, is you should think in bets. So rather than saying on X date or at X price, I'm going to get out completely, as you approach that date, or sorry, that price, or whatever your exit strategy is, and the probabilities have changed. You now have the ratio between upside and downside has changed, and your portfolio weighting should change with it. So instead of saying I'm going to sell everything on at price X, perhaps start to sell it progressively as you approach price X. And that has been prompted by reading an excellent book, which I would recommend to everyone, called Thinking in Bets by Annie Duke. And there will be a link in the description pages. Now, the one thing I did get right, or kind of half right, at the end of this trade was when I realized I was wrong, I acted and I got out very quickly. So, as you will see from the podcast on our strategies, I play the oil cycle. So my trades in Hunting were less about the individual stock characteristics of Hunting, which makes drill bit technology for downhole shale oil rigs and oil rigs in general, and is a very high quality technology company. And I will be doing a separate share talk on Hunting because I bought some more recently. But here you'll see my trades in Hunting as a function of the oil price. And so I bought some in early 2015. As the oil price drifted off further, I bought more at the beginning of 2016. Now, by the end of 2018, I knew that this trade was ending, that the reasons that I had bought into oil were changing. So the run of inventory drawdowns in the US, which indicated that there was a demand, there was a supply deficit, were now ending. and the market was moving into balance, and it was then going to move into surplus. And so, and I'd made, frankly, quite a lot of money. So then I sat down and I thought about how I was going to exit this trade. And my thinking process was, I've generally tended to exit these trades too early. You should run your winners. And I know that there is a strong seasonal effect whereby oil prices and the market in general tend to have a strong run into the year end. So this is probably in August, I sat down and thought about this, and I decided that I was going to sit on my hands and liquidate the whole portfolio during the traditional seasonal upturn in the first 2 weeks of January. Unfortunately, the market had other ideas, and in October, there was a very short, very sharp market drawdown in the oil market, which some of you may remember. And essentially, for the first week or 10 days, I sat on my hands and I was saying, just sit through it, stick to your agreed strategy. And then I rapidly realized that if I did that, I was going to lose all my profits. And I turned around, and in 2 days, I liquidated the entire portfolio. So these are the details of my trade in hunting. So I initially bought some at just under £4, and I bought more in 2016 at just under £3. And for a long period, I could have exited, above £8 or well above £7. But actually, I finally sold it all in 1 day at £6.60, which is, okay. And frankly, I could have chosen any one of a dozen companies to do this my worst trade in, because it wasn't just hunting. I owned a lot of oil companies, and in some of them, the share price fall was really very dramatic, and I lost all of the profits. And I would say by mistiming the exit of this trade, I lost at least half the profits. So in those 10 days, the economics of the trade completely collapsed. And so what this taught me is, when you think the trade's over, do something about it. Don't necessarily take all of it off, but take half of it off, think in bets, reduce your positions. The odds have changed, react. And what I didn't do, I didn't react. I thought, everything's going my way. There's still a bit more juice in this trade. I will keep the whole position on. And that bit of extra greed cost me a lot of money. So, Richard, you're on mute.
So very interesting, Keith. It's a salutary lesson, isn't it? That it's not only timing your entry, it's timing your exit and planning your exit, and knowing when to sell to make the best use of your profits is very difficult, and an art in itself.
Well, I think we're both very well aware, Richard, that you can never get the timing at the end, the start and the exit of a trade perfect. But bearing that in mind, I bought into this trade slowly over the course of a year. And then I should have exited it in a similar fashion. But instead, what I wanted to do was sell it all very quickly, when it hit some magic formula. And actually, I think what you have to do is slowly exit out of the trade as well. And
so, Keith, you say out of interest now, you say you have bought some more at this point. What is your exit strategy on this occasion?
On this occasion, actually, it's very much news-led, Richard. So what happened last time was that I was surprised, as was the market, by how strongly shale oil came back. And it moved the market very quickly from deficit to surplus. Now, going forwards, everyone is assuming that that's not going to happen this time. including me, but it may well do. And if it does, my strategy changes. But right now, I think there's absolutely no doubt that next year, the oil market will be back towards its highs in terms of demand, but there will be a structural problem in terms of supply. The supply has been damaged by years of underinvestment. So in summary, think about your exit strategy and think in bits. Okay, so I hope you enjoyed that and you'll check out some of our other podcasts. Please press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And thank you very much for an excellent presentation, Keith. It's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.